Hey everyone, this is Lucas Fertitta, Director of Acquisitions with Three Pillars Capital Group. We are joined by Derek Fasulo, Vice President CBRE. Derek and his team provide multifamily operators with awesome debt terms, both conventional and agency. So Derek, thank you for sitting down with us today. I want to tell us a little bit more about your role at CBRE.
Sure, I appreciate you guys having me on. So at CBRE in Houston, my role as vice president is to source debt for commercial real estate acquisitions and refinances, mostly in the multifamily space. So if I have a client come in looking to buy an asset or refinance an asset that they currently own, I help them find the loans to complete the transaction. So at CB, we have over 300 different lending institutions we have relationships with. So we can offer a variety of lending options depending on the client's needs and business plans.
All right, that sounds really good. How big is your team?
So in our Houston office, we have 11 producers and 11 analysts. So two of our producers kind of specialize, one in hotels and one in senior housing. The rest of us are what they call generalists. So we have dabbled in every property type, but every producer tends to focus on one asset class. So for me particularly, I focus on the multifamily space.
Okay, nice. So what would you say is CBRE's biggest edge over other firms?
Sure. So at CB, we're the largest commercial real estate company in the world, and we are literally a 360 company. And what I mean by that is we do everything in the commercial real estate space, from leasing to investment sales, property management. We have in-house appraisal group, engineering and environmental guys for phase one and property condition reports. We have a large research department, typically located within every major office across the United States. So we know every asset class. We have market intel on every asset class in every market. So we're just really a full integrated company. And for that reason, we provide the best market intel and provide the best services for our clients. So kind of regarding debt, which is, the topic of the conversation today, we're a direct lender for Freddie Mac, conventional and small balance loans. And we are also what they call a DUS lender, a dedicated underwriter and servicer for Fannie Mae loans. So for Freddie and Fannie, we underwrite the deals in-house, and then we service the deals in-house after closing as well.
Okay, very good. So why do you like multifamily over the other asset class?
Sure. So, look, multifamily is one of those asset classes, historically and going forward, that's always going to be in need. There's not going to be some new invention or some new technology that's going to take that away. People will always need a place to live. If you look at retail, for instance, Amazon has kind of, stalled a little bit the development of retail. You look at the recession, 10 years ago, when employment drops, the office asset class suffers. Multifamily fared by far the best out of any asset class during the last recession. It's just a very, very stable asset class. And for that reason, you're seeing a ton of draw from investors throughout the United States and overseas into investing in multifamily here in the United States. It's always going to be in need. And for that reason, I think it's the best asset class to invest in.
Okay, very good. So what markets do you focus on?
So CBRE has, once again, offices in every major market in the United States. So we tend to focus on the city that we are located in. So most of my business is focused here in Houston. With that said, we have done a lot of business recently with all the growth going on in Dallas, Austin, and San Antonio. So we'll follow our clients wherever they do business. And I've done deals as far as Atlanta, Salt Lake City, and Phoenix. So we kind of follow our guys where we go. 90% of my business is in Houston, though.
Okay. All right. Nice. So this is a two-part question. Can you walk us through the process from when a client finds a property to get finance, and perhaps give us an overview of what happens after they send you the financials?
Sure. So as you mentioned, kind of the first step is getting the property financials. So what I typically need to underwrite a property is a rent roll and at least a trailing 12 monthly operating statement. It would be great to get historicals before that, and it would be great to get a pro forma of the client's business plan going forward. But really, a rent roll and a T12 is all I need. I can underwrite the deal based on that, and then I can determine what type of loan regarding leverage, term, interest only I can provide, as well as help the client formulate a business plan based on their plan. So if it's a value add play, maybe we look more at a bridge loan opportunity, whereas if the asset is already stabilized, maybe we look more at an agency execution. And so just getting those financials is kind of the first step. Underwrite the deal, determine what type of loan is going to fit best for that client. And then what we'll do is we'll put a marketing package together. We'll go out to the market and market this to a variety of lenders and get feedback based on that, and then provide a variety of options to the client to choose from for the loan and for the closing. So, I mean, the typical timing, once we get it done, we can underwrite it pretty quickly in 1 to 2 business days, and then market the deal for another week or two, and then select a lender after that. So it's a pretty straightforward process on our part. So yeah, I mean, once we get the lender and pick the quotes, we get an application, we proceed towards closing, and closing is typically 45 to 60 business days. So.
Very good, very good. So, with 2018, you're about to enter the fourth quarter. How do you see interest rates playing a role in transaction volume?
Sure. I mean, interest rates was the topic of conversation at the beginning of 2018. From, kind of the interest rates started kind of climbing, November, December, from January 1st kind of until late February. You saw basically a 45 basis point increase in the 10-year treasury. I think having that at the beginning of the year made people a little nervous and made a few investors sit on the sidelines, kind of waiting to see what happened. Once they experienced that increase, the treasuries got up to, I believe, 295 by the end of February. And so it kind of stalled out a little bit. People became a little more active towards the end of the first quarter, going into the second quarter. And then in May, we saw that huge drop in the 10-year treasuries kind of overnight, where it went from, I think it was 311 down to like 275 in a matter of a couple days. And I think that right there sparked a lot of action from investors to try to lock in rates while they were down. So with all that said, how has it made an impact on transaction volume? Not much at all. People were a little nervous at the beginning of the year. Transactions have picked up. We're actually, I believe it's 8% in the first half higher in 2018 than 2017 in transaction volume. So everyone is still incredibly hungry for multifamily. The interest rates, have impacted returns a little bit, but they're still low historically, and for that reason, I think you're still seeing a ton of volume, and I think you still will see a ton of volume not only the remainder of this year, but for the next few years. So it's just a really good time to get in there and find some good deals and lock in some rates, for the long term and hold these deals.
Yeah, I completely understand. Okay. So when operators are looking at a property, what are the key component factors they should look into before considering a property?
I think this is, it's two things. You're going to look at, property level and market level. And, on the market level, You need to understand your market in and out, the sub-market that you're buying in, as well as the overall market. So what do the demographics look like? How's the population growing? How is the employment growing? Who are the employment drivers? What are the rent trends, vacancy trends? What do the crime statistics look like? So kind of that whole kind of market level look on the entire submarket that you're buying in. On the property level, look for flaws within the current operations. I mean, a lot of times you can go in and create value within a property without even increasing rent, just by increasing operations. You see it a lot of time with absentee owners who are living out of state and hiring a third party group to manage the asset. They may not always be the most hands-on. And so when you come across those deals, you'll often find that payroll and R&M in particular are probably double what they should be. You're kind of putting your trust in a third-party group that you may not know that well. And they have the tendency to, in some cases, this is not all, just in some cases, to kind of run up payroll or run up R&M through contract maintenance and stuff like that. So look for holes like that. There's also things that you can look for, like implementing a RUB system, or putting in things like energy efficient type improvements, low flow toilets, low flow shower heads, LED lighting, that sort of thing, which could impact your utility bills pretty heavily, as much as 25%. So I think those are things to look for on both the market and the property level. And kind of going to my next point off the property manager, these guys are extremely important. They're going to be the ones who interface and interact with your tenants on a daily basis, so they can make or break a deal, essentially. So highly vet your property managers, pick a good one, and it'll do wonders for your property.
Okay, nice. So what do you see are the common reasons that a deal falls through, and based on those, what can be done to overcome those challenges?
Yeah, I mean, really, it's two things that I've noticed that can impact deals. One of which is if something pops up in due diligence that you weren't aware of, and that being some type of large deferred maintenance item, or some type of environmental situation that pops up. And so ways to mitigate that is get third parties ordered before your DD expires. So get those in so you can review those reports, and you can find anything that you may have not encountered during your inspection. And if you come across something, maybe it's an instance where it's an item that you absolutely can't deal with, and you move on to another property, or you go approach the seller for some type of credit or a price reduction. Kind of the second item that I've seen is just equity falling through. So finding a deal, putting under contract, and not having equity in place, and hoping that you can raise it within that 60-day closing period, and you can't hit that equity requirement. So those are kind of the two biggest things that I have seen. And as far as equity, vet your investors on the front end, fill them out. Make sure they're fully engaged and fully interested in the deal, and get that equity raised so you can get the deal closed.
Okay, so let's talk about earnest money and contract terms. Are you seeing a lot of hard money day one on these contracts, and what are some of the other aggressive terms that people have done to win a deal?
Yeah, I mean, I think nowadays hard money is day one is almost the norm in a sense. It wasn't always like that. You'll see it. You've seen it a lot in Dallas over the years, just because that market is super competitive. Where on some of these bigger deals, guys are coming in with $500,000, hard day one. And I think Houston has kind of followed suit, not quite to those extremes, but I think sellers somewhat expect that nowadays. With that said, I don't think that it's kind of the number one thing that sellers look for. I think sellers look for buyers that can close and have the reputation to do so. So because, hard money day one has kind of become the norm, having that reputation kind of gives them the comfort, because the end objective is to close the deal, right? So if you go hard day one and you don't close, then they're still in trouble. So they want to know that the buyer they bring in is going to be able to close. So I don't really see any other tactics other than that. It's not like residential where it's a quick close or anything like that. No one's expecting that these days. Any sophisticated and any intelligent investor is not going to try to close the deal in 15 to 30 days just to win the deal. I don't think sellers expect that either. So I think it's just the hard money and then having a good reputation to get some deals.
Makes perfect sense. Okay, so what is your outlook on the multifamily market for the next 2 to 3 years?
Sure. So we'll since I'm in Houston, we'll talk about Houston and Texas in general a little bit. Houston is going through a pretty awesome growth stage right now. We're kind of counter-cyclical to the rest of the country, where we had almost our little recession back in call it 2015, 16, and it wasn't even so much of a recession. I mean, we lost some employment due to kind of oil and gas, but we have rebounded pretty tremendously. And so as our multifamily supply has continued to dwindle year over year and has very little supply coming on the market in the next 3 years, you're going to continue to see, especially in Houston, pretty strong rent growth, pretty strong occupancy growth, because that supply has come down and because our population and employment statistics keep going up. I think Houston is going to be extremely strong the next few years. In Texas in general, I think you'll see much of the same. Dallas is kind of going through what Houston went through, 2 years ago with just a ton of units coming on. With that said, they have the ability to absorb those units. They have one of the top, if not the top, population growths in the country, and the same thing with employment. So, Austin, of course, is continuing to be a strong market, and San Antonio is kind of that little brother that's sitting there who has continually done well, and it's a market that stays stable, and a lot of investors have done well in that market. So overall, over the next 3 years, I think it's looking good for multifamily. So.
Very good. So before we wrap up, I want to see if there's anything else that you'd like to add or mention that would be useful for multifamily operators.
Yeah. So 2 things. Take advantage of your mortgage broker. Send them deals to look at ahead of time. I've looked at deals and worked with clients recently where they've literally spent 2 months kind of underwriting deals on their own, have made flights across country to go look at deals, and then they sent me the financials, and after 5 minutes of looking at it, I told them that the deal wouldn't work and they had to drop it. So they spent all this time and money on these deals for a loan that they couldn't even get. So, take advantage of our time. I'll look at deals for you. Your mortgage broker will look at deals for you. We'll underwrite it. We'll give you feedback before you even submit an LOI. So you know how to model your returns. You know how to model your pro forma based on the debt. And then, it makes it easier for you and your investors to get a grasp on what type of returns you can get going forward. Kind of secondly, and this is just kind of outside of debt, but, as an investor, in particular, it's take action. I've come across a lot of guys who look at deal after deal after deal and just don't ever do anything. you'll probably look at 100 deals before you find one. But when you find that deal, move on it, take action, get in the investment game, especially multifamily. It really is one of the safest investments, I believe, out there for your money. It's going to be something that's always going to be in need. And so take advantage of that. I mean, your deals are, it's very hard to lose on multifamily. I think you saw that during the last recession. Even during a recession, a lot of guys didn't lose on multifamily. So take action, get in the game, put your money in it, and you'll be happy you did so 10 years from now.
It's very good, very good. Well, all right, Derek, I really appreciate your time. For all of our listeners out there, if you want to get in touch with Derek Fasulo, his email address is published below. So again, thank you, Derek. It was very informative information.
Yeah, thank you, Lucas. Thanks for having me.
Very welcome. All right.